Welcome back to another episode of She Means Business, and today I have the pleasure of introducing Rikki Salzer. Now, people ask me on a regular basis, what makes one loan officer better than another? What makes you different than somebody else? And sometimes I struggle in what to say. But one of the things that makes us different is our team and who's behind us. So Rikki is one of our underwriters. She works strictly or mostly in the non-QM space. Non-QM is for what's called non-qualified mortgage space. This all came from like when the whole mortgage meltdown, the government came up with a bunch of restrictions on mortgage companies, and one was called qualified mortgages, and there's different criteria of what it meant to be a qualified mortgage. One of the criteria of a qualified mortgage is the ability to repay, ATR. So the conventional mortgage industry, the conventional side, they looked at this as every single mortgage in the country has to have pay stubs, W-2s, verification of employment, or some kind of variation of that. Something that could be check, government, 4506, however you put it. But then came out in about 2018, a bunch of new mortgage programs came out into the mortgage industry. And a lot of banks were very hesitant about them. Our company, FM, we went full swing ahead into them. And they took Rikki, who was an underwriter doing some other things, and they put her right into the non-QM world. And what we did was we created our own non-QM products and programs. We created a matrix. I want to have a discussion today with Rikki where she can explain what we do and different aspects and how it's different than conventional, and why now that the other banks in the country are getting on board in the non-QM world, how we are way ahead of the pack, and why coming to FM makes a huge difference, especially when we use non-QMS solutions. Rikki, I want to really appreciate you taking the time to sit down with me and go over it. I want to just tell you how I met Rikki the first time. I had an office in Pomona, and across the hall from me was a financial office. And Rikki was hired by the financial planner over there to work doing something for him. And I had a lot of conversations with her when she bought her first home, and I asked her to do the mortgage on her first home, on that first purchase. And at that time, she had been in the mortgage industry in the past, I believe as a processor, but I'm not exactly, was it a processor?
I was doing sales.
You're doing sales, loan officer sales.
Yeah, I was a loan officer.
And it was very interesting. I had an employee with me for 15 years. This is about 15 years ago. And I said, do you know this employee? Because she came from the bank that you were from. And you told me if I can get her to work for me, I should grab her. So I went through the interview process and I hired her because of what you said. I just want to tell you that. So that's how I met Rikki about 15 years ago. So Rikki worked there, and then circling back a couple years later, I wanted to get an introduction from the company. We have a new underwriter on board, and it's Rikki. And so that's how Rikki came aboard in FM. How long have you been with FM?
I've been with FM close to 10 years now at this point. So like you said, I've been in mortgages for probably around 20 years. And that point when it was after the mortgage meltdown, and I was deeply impacted as a loan officer. The company that I was working for at the time closed down. So I did end up going to work in other financial services. But of course, I ended up coming back to mortgages, and I am now at FM. I love what I do.
Isn't it something about the mortgage industry? It gets in your blood, and you just kind of have to do it. I can't see myself doing anything else. It's just something that just gets to you. Either it gets to you or it doesn't. If it gets to you, you're attached.
100%. I've always thought about different things, but I always come back to mortgages.
Yeah.
When I was doing loan officer and I interviewed for my first underwriter job, the guy said to me, most people are either good at one or good at the other. But he gave me the opportunity, and I love what I do.
That's great. I want to jump into the non-QM space. Yes. I just want to explain to you what non-QM can do and how the solutions are unbelievable. I'll tell you about something happening right now as we speak. Right now we have a client with a 460 credit score. His wife has a 780 credit score. So in a conventional loan, we use the lower middle score. So I'd have to use a 460 score. Anything under 620, no can do. So what happened with this loan? Through non-QM, in the non-QM world, in certain programs, we can use the credit score of the higher income earner. In our case, lucky for us, the wife makes just a tad more than the husband. So our mortgage is based on the wife's credit score. So we have a solution, and we're heading into a closing. This is why Rikki is so key to me as a loan officer. I called Rikki and said, do you know any ideas? And she starts to think about our programs. And Rikki, explain to the audience a little bit about what you did, because you create our matrix. So tell me a little bit more about the non-QM space and what we did at FM. Just explain that to us, because it's something that's unbelievable, and we're going to go through, as we talk, some more scenarios of how we've helped people.
Yeah. Like you said, FM is really ahead of the game in this area. We've been doing non-QM for years, so we really know the space well, and we know what can be done and what cannot be done. We have our own guidelines, and our guidelines really take into account the entire, like, across the industry of what works and what doesn't. We know where we can push the limits and where we can't. And the beauty of non-QM is, in conventional, either you fit the box or you don't fit the box. With non-QM, there's always room for exceptions, there's room for some creative structuring if it doesn't quite fit. As long as overall we establish that there is, that it makes sense.
We established an ATR, the ability to repay.
Correct.
That's what it boils down. Talking about that, we had this client recently. I'll give you an example of an exception. So we had a client, and I had a lot of conversations with you on this one. They've already closed. We had a client that was self-employed. A lot of non-QM programs are really great for the self-employed world, because they use alternative solutions to qualify one for a mortgage that they wouldn't be able to get if they had to provide their tax returns. So this particular client was, we use bank statements from the business. We use the business bank statement program. Now, in the business bank statement program, we have a calculation where we use a certain percentage of the deposits, and that becomes an income amount that we use to qualify for the loan. This is great for somebody who's doing their, whether investment property or a primary residence. This particular one was a primary residence. So when I got the 12 months bank statements, everything looked good until I started to count up a non-sufficient funds. So that's a big no-no in the non-QM world.
Correct, because there's no tax returns. The only thing you're relying on for the borrower's income is the deposits to their bank statement. So if the account is running negative, then it looks like they're not really able to meet their obligations. So there is some allowance for, an occasional, but if it's over certain limits, then it becomes a problem.
Well, we've seen this throughout our processors are very schooled in reviewing bank statements. So, like, for example, if somebody goes negative overnight but corrects in the morning, we don't have to count those, right?
We give an allowance. If it's positive by the next business day, we don't hit for it. So there's definitely some allowance for that.
So this particular client of ours had too many non-sufficient funds over the course of the year. It wasn't every single month, but there was like 1 or 2 months where it was problematic. So we didn't know what to do. We needed to find a solution. So the next one, we thought maybe we'll do a profit and loss, because that's another non-QM solution where we have an accountant provide us with a profit and loss that matches what his deposits are, whatever else for the business. So we can use that program also. But the problem was that his credit score was a little bit lower than a traditional profit and loss program. So we had a conversation. We put our heads together. Exceptions, what do we do? So Rikki came up with a solution of a program that we have where we can have a profit and loss, and it's supported with 2 months of bank statements instead of 12 months. And we were able to provide the 2 months bank statements along with the profit and loss from his accountant, and we were able to close on this loan. And I want to tell you something, this loan was really, really very helpful for our client. He really needed it.
That's so amazing, and this is what I love about what we do. It's like people who are so disappointed, they almost made it, and then something goes wrong, and here we're like, let's do it. We have all these different non-traditional solutions, and what you're saying, like, this was just one route that worked for this particular case, but there's so many other different. Let's say we have somebody who has, let's say, 3 different business bank statements that they use, and one of them has NSFs. Well, we don't have to use that one. We can use the other 2. Or we can use just one, or we can use that personal
Rikki, I
bank
had
statement.
one like that. I had one just like what you're talking about. I had a client who came to me. He had a 620 credit score. And I remember having a talk with you about it, and I went to the exception desk on it. And I said, well, the client, well, this is the story with him. I want to get an exception because I have a 621 FICO score, and most of our programs are like down to 660 or so, or 680, and I want an exception for 620. So the route, what I do is, well, this is the route in our company. So I have a guideline. I have the guidelines for non-QM. And I have a client that doesn't fit the guideline for some reason. My first call is Rikki. Rikki, this is my story. 620 credit score. Could we do a non-QM 620? So she comes back and she searches our investors and our programs and says, well, we can do 620 this route and this route, but I need to get an exception because not in our guidelines. So I went to our exception desk and I discussed it, and he says, well, why is his credit so low? Send me a copy of his credit report. I said, it's not so bad. He just has a little car issue. He had 2 repossessions. He had 2 repossessions like 2 months before. Wow. So the client tells me it's not a big deal. I redeemed them. They're okay. Well, what happened was that this guy had always had very good credit, and this can happen really to anybody. He had really always had very good credit. He leased his cars. He turned in his leases, got new leases, and he gave it to his secretary to take care of, and she put into the auto pay she made a mistake on the account number. He's busy, he's traveling for work, right. And the auto pay is now coming out 1 month, the second month. He gets hundreds of phone calls a day. He probably did get notified, he probably did get a phone call. He kind of ignored it. Secretary takes care of it. One day they come to his house after 3 months, they repossessed his cars out of his driveway. So he right away got on a phone call and found out, like, what the heck? Why wasn't the money being taken out? There was a mistake. So he did a paperwork mistake. And so he ended up with repossession. So he did redeem his cars. He's no longer in default, but unfortunately his credit report suffered tremendously, right. And we had a recent repossession. Right,
and I will reiterate, in non-QM lending, it's not like a free-for-all. We are responsible lending, right?
For sure.
So when we encounter these cases, we're going to try and understand it, like what happened here, and explain that, there was a paperwork issue, that it wasn't just like this guy really cannot afford to be buying a house.
And we never had late payments in the past.
Exactly.
And it was only this particular account. But it's an interesting thing. My point was not about his repossession and the 620 score. Right. It was the type of loan that we did for him. So this guy was, he was in like the nursing home business.
Right.
And he was, he had owned some nursing homes. When he originally sent me his tax returns, one of his nursing homes showed a loss, right. And therefore it would have been very difficult to qualify him for the mortgage that he needed. He was looking to buy a property, and he needed a mortgage that was close to $2 million. So what we ended up doing was we looked at his, I started to discuss different options for him, and I said, let's do a bank statement program for you. So he said, I really can't get the bank statements from all my businesses because I have partners or whatever, what it was. And we discovered that he had 2 of his nursing homes actually paid him every single month. One paid him, I think it was like $10,000 a month, and one paid him $20,000 a month. And we were able to prove through personal bank statements, deposits from his businesses into those accounts. And we were able to provide all the paperwork that was required. And we closed him based on 100% deposits from his business into a personal account. So a lot of times when you talk to a lender about, I want to get a mortgage and I can't show this, or I can't show that, or I have this, or I have that, non-QM gives us all different ways of making it work. And this guy also has successful closing.
I want to bring out a point that you're saying because, we've been focusing on people who don't qualify for traditional lending. But sometimes people like this guy who own like big extended businesses where it's really complex to get all the paperwork, they might choose to go non-QM just for the convenience of it. Because, if they own multiple businesses, some are partnerships, they have to get access to the paperwork. They get one bank statement, they get, a P&L for one business, and they're good to go sometimes, right?
You brought something up very interesting, that you'd think that the programs we're talking about would have very, very, very high interest rates. Like, this is really like the last resort. A person can't get the conventional loan, they can't get the typical mortgage. Okay, what's your last resort? Give me something like a hard money loan. We're into hard money space. The answer is no. The rates in non-QMs are extremely competitive. They're starting in the high 6s. That's where the base rates are. I have found in certain instances, in some investment mortgages, that the non-QM rates are better than conventional. I'll give you an example where that is.
Yes.
If someone's purchasing a two-family home and they want to put down 20% down, you can't get a conventional. You can get a non-QM. That's one. Two, purchasing a 20% down, single-family home as investment, non-QM rates are better than conventional rates, especially when you go over an $800,000 price point. We talked about a couple things so far. We talked about the person with a 460 credit score. The spouse had a higher credit score. We used the spouses. We talked about the borrower who can't provide the 12-month business bank statements, but did a hybrid with a P&L and some bank statements. We talked about the client that has deposits from his business into his personal account using 100% deposits. Let's talk about the one that most people know about, which is what's called a DSCR.
Yes.
So I have to tell you something really interesting about DSCR. I'm part of a group of people that does investing. And it's a bunch of, it's basically almost like a school, and it's a group, and it's a community of young people learning about investing. There are mentors who teach them how to invest. And most of these people don't have the income yet to be able to prove that they can pay back loans, whatever the case is. And most of them are getting DSCR loans, which is debt service coverage ratio.
For investment property.
Only for investment property purchases. And I talk to them, and they don't really have a complete understanding yet of the lending world, the real estate world. But all I hear is, I want to get DSCR. So this lady comes to me. She's buying her first investment property. I'm from New York. She's from New York. It's a different state. She's buying her first one. She goes, "And I want to get DSCR. I need to get DSCR." I said, "Why do you want to get DSCR? In your case, the amount you're putting down, you can do better with conventional. Those people have to get DSCR because they can't prove their income. You can prove your income. So let's do what's best for you." So it kept on coming back. Am I getting a DSCR? I'm like, "No, you're getting a conventional loan because in your case, that's best for you." So we ended up closing her loan, and then she came back that she wants to refinance the mortgage because rates have come down. I said, "Okay." So of course I start her loan. She goes, "What about the DSCR now?" So I said, "If you want your house to be on a LLC," which is the next thing we're going to talk about,
Yes.
an LLC ownership versus personal ownership, you only can go in the non-QM world. And whether I do DSCR non-QM or full doc non-QM, we'll talk about it. So I run her credit, and I start going, and I see she has a mortgage on her credit that she didn't have before. I said, "Where's this $5,700 mortgage coming from?" "I co-signed for my son." Well, guess what? She
Now
co-signed
she
for her
doesn't
son.
qualify.
She doesn't qualify anymore full doc, and we're giving her, guess what? DSCR.
The one that she always wanted. I don't find, honestly, that a lot of people are really familiar with DSCR.
Oh, really?
I don't find that people even know that they can qualify just simply based on the cash flow of investment properties. Maybe you're out there more in this,
No,
on
so
the sales side.
I think that when I talk to a client, I try to explore all options for them. My goal when I meet the client, and sometimes clients don't like when I say this, and I'll say it doesn't sound shocking, because I don't really care what interest rate they get, and it sounds very crazy for me to say that, but the truth of the matter is, my number one concern is get you into the house.
Yes.
My number two concern is the best way possible. I'm not going to put everyone into a DSCR loan because it's an easier close, because there's no paperwork in it.
Right.
It's only based on the rental income. But I'm not going to do that. But I will find the best program for them. That's part of what's being great, being part of FM, to have the whole repertoire of programs. I have the whole conventional side, and I have the whole non-QM side. So I can, that knowledge and the resources that I have, I can put that all together to give a client the best program. But she just, some people had never heard of it before, it's true. And some people know about it, like this case. So it's just interesting that she is going to get now a DSCR because she co-signed for her son's mortgage, and now she no longer qualifies for a different kind of loan. And going back 5 years ago, she wouldn't be able to get a mortgage. That's the difference between DSCR now.
I think the important thing to know about the DSCR, debt service loans, is that there are different criteria. So they don't need income to qualify, but they need to show some kind of home ownership or housing history or investor experience. This comes up a lot.
You're right, Rikki. It's true that all these loans, we have to be responsible lenders. So there's criteria for all these loans. It's not just open season. It's not 2007 and 2006 again, where you just breathe, you got a mortgage. It's not like that. There are rules, there's guidelines, but we have at FM, we have that availability, and a lot of it really, Rikki, is because you were tasked to do this for the company. And you did it. You rose up to the occasion. When you started with FM, did you have any clue?
With the rest of the team, no.
No,
I
of course.
had no idea.
Of course, the whole team was behind you, but did you
Yes.
have a clue? This
No
is
idea.
this is the route you take in your career.
No idea. It's been amazing.
Really?
It's really, really incredible watching this grow from like ground up.
Do you feel like
we
your
were just-
baby?
Yeah. Yeah.
So the non-QM programs is like your baby, and the matrix is like what? That is the baby.
I mean, I don't make up the guidelines. I don't make up what we do. I just put in the work to help out, to advise like what's going on in the market and what I believe we can sell. So if I see like across the industry, this is a certain standard, then I'll be like, okay. So I give my input to it, but it's not like I design the language. I'm not.
I think you're being very humble here. You don't create. It's true. You don't create the guidelines. You don't create the investors. You don't create that part. What you created was a matrix that we can all go to, that solved that so we understand what we can do, so we can help our clients. And now, at least to me, sitting at my desk as a loan officer, you are a huge resource, mostly for my exceptions.
I think like that's where I feel I did play a role. Maybe other people have different opinions, but it was like about teaching people how to understand non-QM and utilize these guidelines. Because a lot of times people just do what they know, and this is like a whole other world. It's a different animal sometimes, and I love teaching people. That's what I loved.
Here's another client that we had that we really helped, and this was a very interesting one. I needed Rikki's help a lot. And again, what's my focus on this podcast this time is what makes us different than somebody else. And what makes me different as a lender is who my team is. So we had this client that came to us. He had one job, which was hourly job that he worked. He had another job, which he got paid a salary. It was a constant job, but it wasn't a full-time job, but he got paid a salary. So he was able to do both. And the last thing was he had a trade that he actually worked in, and he got paid for that through private, whoever he got paid for that. And that particular job, he would file as a sole proprietor. So we had 3 different forms of income, and we were going to do what's called a profit and loss for 12 months. And this is very key. A lot of people have jobs that they've done or things they've done, and they're in it for 2 years. But in the conventional world, you have to show 2 years on a tax return, and it has to be 2 complete years. That means it's 24 complete months. Now we're in August, so we're 8 months into the year. And we can have someone who started their self-employed career, 25 months ago. But for conventional mortgage purposes, we can't use this income. In this case, it was a third income. And I had to show 24 months on their tax return. I couldn't show just 12 months, 12 and a half months of income, whatever it was. So in the non-QM world, we can use a 1-year tax return. We can do a profit and loss for 1 year. We can do bank statements for 1 year. We were able to show on the 2 jobs that he had, the 2 employment jobs that he had, the hourly job and the one that he did a consistent job, that he had 2 years of history, because there was a job change in those.
Right.
But on the self-employed, we had 2 years as being self-employed, but not 2 calendar years.
Oh, for sure.
So what happened was we were able to use that because his 2 years doing it,
Right.
but his tax returns were only a year and a half.
Right.
Because at the time when we were closing,
Right.
we didn't
It was
have
for
the
mid-tax
first year.
year.
So that was the difference. So
Right.
we were able, because on a conventional side, had I had the 2 years tax returns, I could have done this conventionally. I couldn't do it conventionally because I didn't have the 2 years tax returns. So that's why I fell into the non-QM space. So I was able to get a profit and loss for that self-employed portion and use the actual verifications of employments and pay stubs for his other jobs. So here we had a hybrid with 3 forms of income. And just to add to that little mix, that was the husband. The wife was returning to the workforce. So it was another little caveat. She had worked the job for a number of years. She got sick. She took a leave of absence for 8 or 9 months. Thank God she was better. She went back to work. And we actually closed a loan the same week she went back to work. It wasn't like she was on the job for 3 or 4 months already. So it was a very complicated employment history. And what I love, you said you love to help people, you like making solutions. I get such a high when you have the puzzles and it seems so difficult and everything kind of has to fall exactly into place. And that's what happened here.
I was just going to say, I mean, that's a credit to you that you have the patience and the determination to, because some other places would be just like, decline, you don't qualify. And you're like, no, you take the time, you're like, let's figure this out. We've got to have a solution, right?
Well, that's I think comes from when I meet every client. I do the mortgage form. If I don't meet, I do a Zoom call. If I don't do a Zoom call, I do an hour phone call. I mean, it's important to me to really understand my client and get to know the client, because then you can think of something. When he was talking to me the first time, he says, well, I also have this other business that I do this and that. And I'm like, okay, great. I need 2 years tax returns. Well, the year before I was only doing it for a few months. I said, oh no, what are we going to do? And then I was able to figure out, he's 2 years on the job, let me figure something alternative. And then I called Rikki. I said, Rikki, can I do this? I remember calling all these questions. I said, can I use 3 different forms of employment? And you're going through it. It was actually more complicated. One of the jobs was like different. That's what you're remembering. You're remembering the complication of one job going to the next, one going from part-time to full-time. That's what you're remembering. But I'm saying that we had the different kinds of jobs, and I had to throw on to Rikki, what about the wife returning to the workforce? Is that allowed non-QM? And it was okay. So that was really a lot of fun to put that together and really get this family into a home. It was really, really, really great. And it's interesting, I do a client appreciation event every year, and he came to the client appreciation event, and he brought his son with him. His wife came in, and he came with a severely disabled son. And one of the reasons why it was so important for them to buy a house was because they were in a rental, and the house they're living in, the seller needed it back for whatever reason, and they just can't move anywhere because they have to have a place set up for this adult son, and they couldn't find that in a rental. And so a home was so important to this family. And when they came there, and I saw this young man, and he's probably over 30, and he's clapping with the children, but he was part of it, and it makes you feel warm and fuzzy that you're able to do that for somebody. Let's talk about some other non-QM programs that we had. We have a program, a 1099 program. So that program, a 1099 is there's different forms that people get paid in different ways. So a person could tell me they have a job. And when I get the paperwork, they give me a 1099 form, which is really a self-employed form.
Right.
And it's filed differently on their tax return. So in the traditional mortgage world, we look at the net numbers. So I recently had this guy, and he comes to me, he tells me he makes $3,500 a week. And I said, great, $3,500 a week, $180,000 a year. Everything seems cool. I get his paperwork, I said, send me your paperwork. It's a 1099. Which means, and then I look at his tax return, and that $180,000 income was netted down to in this case, it was $4,300.
Because most self-employed people are trying to write off as much as possible, so they're gonna put expenses on their tax returns. So this is important for accountants
to hear this. I tell this to clients all the time. I said, your accountant and me, we're not on the same page. They're looking to save you on taxes. I'm looking for you to file more income. So we're not on the same page. So these particular programs for an accountant is them having their cake and eating it, because they get to file tax returns the way they want, and the clients get to get into the homes like they want.
They're basically qualifying off the gross income rather than the final income that was filed on the tax return. We do take a 10% deduction, but that's it.
Right.
It's just like a flat 10% deduction.
So I had this client also told me he's getting paid a certain amount. Turns out he's on a 1099, and I was able to use the 1099 as the basis for our income. We took off 10%, 90% of that, and we were able to close.
I just had a question, because this comes up a lot, where people are employed by relatives. So sometimes it's a problem, because then you have, different programs don't allow just minimal documentation. All we require is like a CPA letter saying that they have no interest. Let's say the 1099 is coming from a family-owned business, relative-owned business. So we just need a letter saying that they have no ownership in that business. But we can still do the 1099 only. It doesn't stop us from doing that.
It's so funny you brought that up because I learn something new every day. Before this podcast, I had absolutely no idea that there could be a problem on a 1099 program if you're employed by family. And the story I just told you before, he's employed by his brother. You know that? I didn't even know it was an issue.
We probably documented it.
We for sure documented it, but it's kind of just happened. But I didn't even know to question that. Thank you for bringing that up.
Sure.
I know on the conventional side, if you're employed by family, we have also a lot of different criteria because, people ask me all the time, like, what's the difference? I'll work for my father. He'll pay me $75,000 a year. As soon as I find a house, just tell me. And I'm like, well, that sounds really nice, fun, and dandy, except you can't use family income that happens like that. You've got to show you've been employed for a certain period of time because the mortgage industry looks at family income as possibly being compromised because it's being offered in order to qualify for a house. So the 1099 is different based on the receipt of the 1099. Another time that I was able to really help somebody with a non-QM loan. So I had a client that she was a widow and she had a lot of assets. She was extremely nervous. She was a very nervous buyer. She was alone. And she was buying a home and she needed to be in a certain neighborhood to be near a family member for support. And she was on a job and she made enough money to qualify for the loan and I was able to pre-approve her. It wasn't such a big loan in context to what she was purchasing the house for. That house didn't work out. 7 months later she comes back to me, now she found the perfect home. Unfortunately, the job that she had was like a contract type job. Or actually wasn't a contract type job, but it was, her department was closing down within the next 30 days or so. So there's no continuance of employment and she didn't have another job lined up. And so she wanted to really buy this house and she didn't understand if she buys something for, let's say, in this case it was like $800,000 and she's paying down $500,000 and only getting a $300,000 mortgage. Why wouldn't the bank lend her the money? I mean, after all, she never paid her rent late before. She had a house in the past that she had perfect housing. She's putting down more than 50%. Like, why wouldn't the bank just give her the money? So we're going back to the law that we talked about earlier, ability to repay, and you can't use equity or you can't use credit history as a criteria to giving a mortgage. So I had to sit down with her and figure out how much money she had and whether she qualified for a program that we call asset depletion. And Rikki and I talked a lot about this. My processors talked a lot about it because it turned out to be pretty complicated. And that was because she was young, she was in her 40s, she didn't have the same access as somebody who's over 62 to her retirement funds. So she had all different kinds of funds. She had savings accounts, she had stock accounts, she had money market accounts, she had annuity funds, other retirement funds, and each one has different criteria of how we use it. So asset depletion seems very simple. What does it mean? You take the assets you have and we convert it to an income number. But in this case, every type of asset that she had different conversion. So we had to work a lot hand in hand to make sure that we applied it properly. And I have a question, Rikki. Of all the loan officers at FM, do I have the most questions?
That's what I do with my day, is answer questions.
And do you learn a lot on us too?
Of course.
Yeah. So this one over here was we learned a lot in this file because we learned the different nuances of asset depletion because, as I said, each form of income was different. And our underwriters, like Rikki is in charge of non-QM, but our other underwriters are the ones who actually underwrite the files. Rikki doesn't underwrite individual files. She's more like the person to go to see if a loan can be done or what exceptions we might need and if we would likely to get it or not. So the underwriting the file was working with us, with Rikki, back and forth like in a triangle to make sure this all happened and we were able to close the loan and we're good. So that was something we helped another client with also.
Asset depletion is amazing because you can use it in combination with other full doc income or on its own. And now we have the no DTI asset depletion as well.
You know, that's one program I didn't do yet, an asset depletion with no ratio. So how does it work?
It's one of our newer products, which is probably why you haven't done it. But basically, there's no debt to income ratio. So as long as they have enough funds in their bank that equals a certain formula, which is 100% of the loan amount, plus a little bit for reserves, plus a certain amount to cover whatever monthly payment obligations they have on their credit, that's it, done.
That is fabulous. So anyone watching this thinks they'll fit into that program, give me a call. We're probably the only ones out there with it. We went through quite a few of the programs that we have. I just want to say this whole purpose of this podcast was really to show you like how we all work in the company as a team. And I know there's a, as I said earlier, people ask me all the time, well, what makes you different from somebody else? And I struggle with that because honestly, I think that 80% of what we do, we have the same products. I mean, people come to me and say, could you match this person's rate? And the answer is usually yes, because our rates are very competitive. And so 80% of the programs we have, every bank has those same programs. But when it comes to the non-QM world, I think that we attack it in a much, much better way. And that 20% is what sets us above other loan officers and other companies. And it's all about, I always tell people that, it's not really, it's about the company, because some companies, believe it or not, don't close loans. There are companies that they get stuck in themselves, and everything seems to work, but they can't seem to make it work. Unfortunately, there's mortgage companies like that out there. And then you have also, then you have companies also don't have a good team in place, or they don't have the attitude of what do we need to do to make it work, have a very good exception desk. They don't have that.
I really, I know that from the customer end. I've been a customer. I've walked into a high street bank and said, do I qualify? Yeah, you qualify, and then they decline you.
That happens a lot.
I know I qualify. And that's the difference with when you get service like yours. And I think it's also really, we have a very expanded product, because people come to me and they're like, well, so-and-so does this, well, so-and-so does that. I'm like, yeah, but do they do all of it? So we really, you could go running around from one person to the next trying to find out who does which thing that you need, or you just come to us where we have a really very strong non-QM program.
Well, I'll tell you, for me, being a loan officer, I could read guidelines, and I will read a guideline. I learn a lot from reading guidelines. But sometimes my first go-to is, for me, it's important to have someone like a Rikki on my team, whether it's Rikki when it comes to non-QM, it's Shoshana when it comes to conventional and jumbo. When I have somebody as a go-to in the company where I can make a phone call, and I know I'm annoying, I know I call a lot, I know you're busy.
Annoying.
Well, it could be.
No.
I could be annoying.
Mostly not.
Well, no, it could be annoying. It's okay if I am. I'm not doing it. I'm doing it for a good thing, to get my loans closed. But the reason I ask a lot of questions is I learn a lot from those questions. When I ask you a question, Rikki, you go off in so many tangents. And that's because there's so much going on in your head, because you know so much about different programs, and you're trying to put it all together. But every time you go off on that tangent, I learn something from it. And I do. And then we figure out a solution that I can apply to the client. And then I have to make it all gel. It's not just what you tell me. Does the rate work? Is the rate going to be too high that we fall out of compliance from a high cost? Then the rate has to work. Then I have to find out from the client perspective and get every single thing that we need to make this work. I need to show on the bank statement no non-sufficient funds. Does the client have that? I need their accountant to write a letter. Do they have an accountant? Do they have a tax preparer? Who is doing their tax returns for them? Some people are okay, some people are not for some of our programs. Or do I need to find out, there's just different things we just need to find out. Talking about asset depletion, I had this client, and everyone's going to think this is funny. It's not even funny. The client lived in a home, and it was actually in Brooklyn, and he told me that he's getting divorced, he needs to get a mortgage. And before he got divorced, he told me, my wife wants her part of the equity out of the house. Can I sell half my house to somebody else? Because I own half, and she owns half. And I said to him, okay, you can sell half your house, and you're going to go to bed with someone else's wife in the next room because you split half your bedroom in half? Like, you can't just sell half of your house. Because that's exactly what I said to him. You're laughing. But I said to him, how are you going to make this work? You're going to take half the bedroom, and his wife's going to take the other half of your bedroom? Like, you can't split your house in half. He goes, well, what should I do? She wants to get divorced. She wants an equity. I don't want to sell right now. I don't want to do it.
Right.
And he was thinking about selling. And then I said, let me figure this all out. So in this case, the wife had the bulk of the income. But he had a lot of assets. And I was able to use his asset depletion. And it just, you know what it did for him? He was able to buy out his ex-wife. It was part of his divorce settlement. They were amicable together. He got the house, became all his. He didn't have to sell to somebody else's wife to share his bedroom. And then afterwards, he called me recently that he's actually selling his house that he bought. He's going to sell it, and he's going to buy another house. And he had that albatross, the divorce, the whole financial piece that he didn't know how to handle it, how to go around it, because he couldn't just do it. He couldn't do it any other way. And I'm glad I was able to help him do that. Yeah. And it was like, again, a lot of phone calls. How can we do this? How can we make it work? And we put it together.
You know, I want to speak to something you said earlier about, like, do I learn from you? And the truth is, like, people call me and they're like, they kind of have this attitude that I know everything. And the truth is that most of the times, there are certain things that come up, like, frequently, that, you know, common questions, common situations. But most of the times, it's always something new. And I don't come to this with the approach that I know how this works, I know everything. It's an approach of, how do I build a case for this person? And just having those conversations, understanding the situation, taking it apart and building a case. And I think that's what I try to do. And I think as a team, I think we do pretty well at that.
Right. I think that we do that very well. Rikki, I want to thank you so much for your time. I want to ask you something. This is throwing something out. You don't know what I'm going to say. I want to ask you, you can give me about 5 to 7 minutes every single day to tell me something that you learned that day in the non-QM world to help me be better at what I do.
Sure.
Like what you just told me now about that,
and
the
you
new
tell
program.
Me something new too.
And I'll share something new with you. Deal?
I love that.
All right then. Thank you for watching She Means Business. I really do mean business. Want to help you get your loans closed in the best way possible, the best program possible, using all the resources that we have to make you have a successful house event.